So if you live in Colorado, specifically the Westminster or Broomfield area, you may have driven past this weird building that looks a little bit like a satellite. There's a reason it looks like a satellite. Uh, this is the company MAXAR, and they provide satellite imagery and intelligence and some spacecraft and robotics um, for civilian side and military side. What's interesting about this company is it's being bought out by a private equity firm called Advent. This creates an opportunity. It's called merger arbitrage, although it's not exactly arbitrage, where a company agrees to buy another company at a specific price, but it doesn't trade at that price until the deal goes through. So there's a tiny spread in between now and about 5, 6 months from now that you can collect, right? So the deal is to buy a Maxar at 53 a share, and currently it's trading at around 51.47 last I checked. And so the total deal is 6.4 billion, and that majority of that coming from Advent, and then 1 billion from some other private equity firm. So why does Advent want Maxar? So they believe that they see value in providing capital to Maxar to fund space operations. So Maxar being a public company can provide some issues where their job is to launch satellite imagery, satellites into space, and that's a one-time cost that's extremely expensive. So getting the capital required to do that can be difficult at times. Advent is pledging that they will provide the capital to hopefully get these satellites up faster, and that will make the company more profitable in the long term. So that's their idea. And then why would Maxar accept this offer to go private? So they're getting a huge premium for this. It was trading at, I think, 20, 25 something dollars, and then shot up to $51 after the deal was announced. That's a huge premium of 125%. This gives them better access to capital, and it will continue to operate as normally after the deal goes through. This deal also includes a go shop period from that ends 14 February of 2023. So there's a chance on this date that if the market implies any sort of chance that they might get a higher bid, which I doubt that's baked in given the huge premium, but if it is, you might see a decrease in price on that date if no other bid comes out. So if no one comes out and says they want to pay more than 53 a share for this, that is a sort of binary event date, or the first binary event date. Second being if the deal closes or not. So another thing I want to bring up is how is this different from another ticker, AJRD, which is a rocket company. Sort of similar in the space defense merger acquisition space, right? That deal actually fell through once and is going through a new deal now. I think it fell through with Lockheed Martin, and now it's going through with L3 Harris at a slightly higher price. This was shot down. So one of the biggest uh, things that can happen to a merger arb is regulatory action. So the FTC came in with AJRD and stopped the deal. So I want to kind of compare AJRD to the Maxar deal. AJRD is rockets, and they specifically said that the acquisition would have eliminated the country's last independent of supplier for key missile propulsion inputs and gave Lockheed Martin the ability to cut off competitors' access to critical components. So this company creates the components for solid-state rockets, and Lockheed Martin would now have all those assets themselves. So if they want to stop some other company that also makes rockets, they could inflate the price or kind of make it difficult for them to get those components. That could be a huge problem because we want to make sure that the production of our missiles isn't getting screwed over by some private company or just one company in general. You don't want to have a single point of failure when it comes to rockets that defend your nation, right? This is different. This is mostly a satellite imagery company. So you're not going to get that same regulatory scrutiny that you would with AJRD. So I think in that sense, even though it's sort of in a similar industry, this deal is way different and probably has a higher chance of going through because of that. And then personally, from my own uh, professional knowledge, the use cases for satellite imagery in the military is huge. And what I've noticed is from my own background knowledge and from what I can find on MAXAR websites, um, I will say that the implications for military use are a lot higher than what you can just kind of find normally, which gives me an even stronger conviction for this deal, right? Okay, moving on. Uh, One way you've actually used Maxar is by looking at satellite imagery of the war in Ukraine going on right now. The thing with these satellites is once you put them in orbit, they're most likely in a low Earth orbit and they're spinning around the Earth really fast. The Earth is also rotating, so these satellites are, once they're up, they're kind of seeing everything. And you can't control what countries you don't want it to fly over. Right now, we have an agreement, or the U.S. has kind of come out and said that if you attack any of our space assets, any of our satellites, we can attack you in any domain. So we have these imagery satellites that are floating around, and they can see everything. So huge for intelligence, right? That's why I'm saying the military applications that they can't really go into on the unclassed side on like their own website. It has huge implications for intelligence, right? And they can't just shoot these satellites out of the sky because you create a bunch of space junk. And well, we have told other countries that if you attack our satellites, we can attack you in any way we choose. So attack our satellite, we nuke your country. So it just won't happen. So we have these assets now all over space so we can see a lot of things. Big thing, it's good for intelligence, right? So you've actually probably seen MAXAR satellite imagery when you've looked at any sort of conflict in Ukraine or any imagery from that. So it has good use cases even on the civilian side. So we're looking at this from a merger arbitrage standpoint. So how can you profit from this deal going through? There's a few ways you can do that, and I'm just going to bring up this. Okay. So you can buy shares. Buying shares is probably the most inefficient way of doing this. If you buy the shares at 51.47 and it closes at 53 in 9 months, you're getting about, or sorry, 6 months, you're getting about a 3% return in 6 months, whereas treasuries are yielding 4.5% in 6 months. So why would you take the risk of doing this when you could just put it in a government treasury and get 4.5%? It wouldn't make sense, right? So I'd propose another way of doing this. You can sell a put option or derivative, whatever you want to call it, and that will use your account's buying power rather than cash. You'll actually get credited the premium, and you can sell the contract that way. So an example of that would be if we know that the closeout price is 53, we can sell the 50 strike put. You'll get $125 in premium, and that will eat up some of your buying power. Now, how much buying power that eats up depends on the type of account you have. So if you just have a normal margin account, your buying power should be about 2 times whatever the cash you have in it. So I put an example here. If you have $10,000, you'll have $20,000 of buying power, and each contract that you sell will eat up about $1,500 in buying power. So if you wanted to, you could sell enough contracts to get a 16% return on $10,000. So way better than the 3% return. However, if the deal falls through, you're losing almost all that money, right? So that's the risk involved in this. It's a very high probability event going on the long side. However, if it falls through, the risk is this thing goes back to $20 a share, right? So it's a little risky on the same side. What's interesting about this is you can actually, if you're already invested, if you already have a brokerage account, and you don't have any cash, even if you just have a margin account, you'll still have buying power available. So when we look at position sizing, you want to look at the return and the volatility of an. This is kind of going down a rabbit hole, but just bear with me. You want to look at the return and the volatility of an asset. For me, I have weighted my portfolio of index funds in a way that I've sort of maxed out the return and volatility that I want. However, if I can find something that's uncorrelated to the market, being a binary company event that has a high probability, and I can get a 16% return on my money utilizing buying power instead of cash, and then I get the cash credited to me right away, so that offsets any margin balance that I have. This creates a huge opportunity. If that's confusing, I guess leave a comment and I can try to explain or make another video specifically on that. But that's what makes these merger arbitrage deals extremely profitable if you know what you're doing and you're confident in the deal going through. I've recently done this with a biomed. They were bought out by Johnson and Johnson, and then earlier in the year with Twitter. That's kind of a more mainstream one, and then a few other smaller names that I just kind of don't remember right now. It gets even more interesting if you have a portfolio margin account where you have access to a lot of buying power. So in that case, you're not going to max it out, but you get to choose how much you want to risk, right? So if you have 100,000, you'll have close to 1 million if you're not invested in anything. You'll have close to 1 million in buying power, and it'll take about 1,000 per contract. So you could sell a lot of contracts, right? So buying the shares, if you want to participate, probably not the greatest idea. Another risk here is that these options are not very liquid. So if you, especially if you go down in strikes, if you try to limit your risk, maybe sell the 30 strike put or the 40, there's probably less liquidity there. And then you're also paying a fee, and this will also get taxed short term. So there's definitely some not so good things about this as well. But again, the advantage is if you're fully invested, you can use your buying power on something like this. And then again, do your own research, right? Confirm what I've said and try to dig deeper and figure out why this deal may not go through. Because when these things fail, they crash and burn really hard, and that might suck. Final note is that Warren Buffett actually uses this strategy. Uh, there's he calls them not like merger arb, which I don't like calling him that, but we'll just call it that because that's kind of the industry standard for some reason. He's currently in one with Activision. That one's not going so hot, but it is a legitimate strategy, and I think the key to actually profiting from corporate events like this is not using cash. It's selling the derivatives or using some sort of derivative strategy, using your buying power, not your cash, right? So, hope that helps. Hope that was interesting. Try to give some personal knowledge I have on the industry. I just went to a class and we actually talked about satellite imagery, and MAXAR was one of the companies that came up. So, huge use cases on the military side, huge profit potential for you personally. Even after, you can still profit even after it's gone up 128%, as long as you're clever in the way you structure your derivative trade, right? So, and I like calling them derivatives because it makes me sound smart. All right. Hope that helps. Peace.